International ETFs. Should you invest outside the US? Most Americans keep 100% of their investments in US stocks. But here's what they don't know. The United States is only 60% of the world's total stock market value. You're potentially leaving trillions of dollars in growth on the table. Today, I'm breaking down whether international ETFs belong in your portfolio and exactly how much you should own. Part 1. The case for going global. Let's start with the numbers. If you invested $10,000 in the S&P 500 10 years ago, you'd have roughly $27,000 today. That's incredible. But here's the thing nobody tells you. There were entire years where US stocks underperformed international markets significantly. Take 2022. The S&P 500 dropped 18%. But developed international markets? Down about 15%. In 2023, the US crushed it with a 24% gain while international lagged. But flip back to 2020, and international stocks actually outperformed after the initial pandemic shock. This is diversification in action. When you own only US stocks through your 401k and Roth IRA, you're betting everything on one horse. And yes, it's been the winning horse lately. But in investing, recency bias is dangerous. Think about this. Some of the world's biggest companies aren't American. ASML controls 80% of the global semiconductor manufacturing equipment market. They're Dutch. Nestlé generates massive profits across Europe and Asia. Samsung dominates smartphones outside the US. If you own only S&P 500 stocks, you're missing these secular growth trends. Emerging markets are another angle. Countries like India, Brazil, and Mexico have younger populations and faster economic growth rates than the US. By 2050, emerging markets could represent 60% of global GDP. If you're young, in your 20s or 30s with a 40-year investment horizon, exposure to this growth could meaningfully impact your retirement. Part 2. Why most people skip this. Here's the honest truth. International investing is harder. When you buy an S&P 500 ETF through Robinhood or Fidelity, it's simple. The companies report earnings in English. You understand their business models. You know McDonald's. You know Apple. International stocks add complexity. Currency risk is real. The Japanese yen fluctuates against the dollar. That affects your returns directly. A 10% gain in a Japanese stock could become a 5% gain if the yen weakens versus the dollar. Political risk exists too. You're exposed to foreign government decisions, regulations you don't understand, accounting standards that differ from US GAAP. It feels scarier. Plus, the US market has genuinely crushed it for nearly 15 years. It's easy to think, why fix what isn't broken? But that's exactly the trap. Markets rotate. What dominates for a decade underperforms the next. Part 3. The practical strategy. So should you invest internationally? The academic consensus is clear. Yes, but strategically. Most financial advisors recommend this split. If you're building a diversified portfolio, allocate 20% to 30% toward international stocks. That's it. That's your hedge. Here's how to implement this practically. If you have a $50,000 Roth IRA, you'd allocate roughly $10,000 to $15,000 in international ETFs. The easy way? Buy one of these. VEA tracks developed international markets. VXUS tracks the entire world excluding the US. IEMG focuses on emerging markets. These are available on every platform. Fidelity, Robinhood, Vanguard, wherever you invest. A simple aggressive portfolio looks like this. 70% VTI, which is total US market exposure. 20% VEA for developed international. 10% VXUS or IEMG for emerging markets. Buy these once. Set it to auto-invest through your 401k contributions. And forget it for 20 years. The currency risk? Over long time horizons, it smooths out. Yes. Some years the dollar strengthens and international returns look weak. Other years the opposite happens. You want to own both. One critical point. Don't overweight this. Beginners often swing too hard into international and own 50% outside the US. That's speculation, not diversification. The 20 to 30% sweet spot balances growth potential with stability. Call to action. Here's your action today. If you haven't diversified internationally yet, open your Roth IRA or 401k and add one international ETF. Just one. That single decision could meaningfully impact your 30-year retirement. If this breakdown helped, smash that subscribe button. We're dropping videos on portfolio allocation, asset location strategy, and tax-efficient investing every week. Your future self will thank you. Start small. Start today. Your global portfolio awaits.